President Biden's proposed capital gains tax increase would not raise revenue, at least not nearly to the level that it's currently being pitched as. If you haven't heard, the White House has said that it wants to raise the capital gains tax up from its current level of about 20% all the way up to about 40% to raise all of this revenue to pay for all the expensive programs that the government is currently running. The idea, as proposed by the Biden administration, is to tax those people making more than $1 million or something like that at a much higher capital gains tax rate so that they can't take advantage of the much lower rate that they currently do now. And while that sounds like it would be the case on the surface, it ignores the realities of the tax code, and I definitely want to talk about that in this video. But before I get into that, just want to introduce myself for any of you who might be new to the channel. My name is Jack Duffley. I'm a 24-year-old real estate investor, and in just a couple of weeks I'll be a real estate attorney as well. And on this channel I cover a variety of topics as they relate to investing and personal finance, so if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. But back to this capital gains tax hike. The government is running massive deficits right now, so having more tax revenue would theoretically offset much more of the deficit, but the deficits are pretty massive right now, so the tax hike would have to be pretty substantial to make up for all of the deficit. The idea with the capital gains tax is to raise a lot of revenue, specifically targeting rich people who have lots of capital gains that they currently take advantage of. Whether you believe rich people are taxed fairly or unfairly in the US is beside the point of this video. The point is to discuss what rich people would actually do if this proposal were to actually go through and pass and the capital gains tax rate would jump up to 40% or something like that. Because if you think that a rich investor is just going to sit there and take this capital gains tax when they want to get their money, you are sadly mistaken, because there are tons of loopholes to take advantage of to circumvent a would-be capital gains tax up near 40%. And the first tool that would probably be heavily utilized, in fact it's heavily utilized right now, is margin debt. Now if you're unfamiliar with stock investing, margin debt is debt that is attached to your stock portfolio. So if you have a big portfolio of a bunch of companies, maybe you have $100 million in Apple stock. You're a really rich investor after all. Okay, you have $100 million in stock, but maybe you don't want to sell that stock, but you see some opportunity somewhere else and you want to spend money on something. Maybe it's not even an opportunity, you just want to fund an expensive vacation, but you don't want to sell your assets. So what you do instead is you go to your brokerage and say, hey brokerage, I'd like to take out a margin loan against my stock. The brokerage then gives you a loan for whatever amount, some percentage of your stock portfolio, whatever you agree to, and often it will be at a very low interest rate right now, and there you go, you have your cash in hand, and you still get to keep all your stock. It's just that now you have some debt against that stock, but you still own the stock. It's much like taking a real estate mortgage out on a piece of real estate. In either case, you keep the asset, and then you just have debt against the asset, but you get to keep the cash or liquidity in the meantime. And then that cash can be used to buy some other investment, fund some expenses, and then you pay back the debt later with dollars from somewhere else. But the key factor here is that the margin loan itself is not taxed, and in many cases the interest on margin can be deductible depending on how it's used. Talk with a tax professional, of course, since everyone's situation is different, but in many cases loan interest is going to be deductible. But you might argue that they really haven't changed their position that much. They've just kind of leveraged their existing position, but they're going to have to pay back that debt eventually, and that money's going to be taxed at some point. And if they ever want to sell the stock, they're still going to have to pay capital gains tax if they have a huge gain on their balance. But in our $100 million portfolio example, we'll say half of that is gains, so that's $50 million in capital gains to tap into. But eventually that's going to be sold at some point, even if they're taking margin on it in the meantime, because they'll sell the stock to pay down the margin, and then they still have that gain to actually take care of on the tax bill. At least that's the thinking. But that's not really where it ends. Now let's say you do that same thing. You take the margin loan out on this large portfolio, or even a smaller portfolio, just you're making more than $1 million, so you're pretty wealthy. Now instead of spending it on a vacation or something like that, let's say you take that same margin debt and put it into something like a real estate deal or something that has lots of tax deductions built into it. Because you're a high roller, you take the $20 million out via margin, that's not taxed. You then take that $20 million and put it into something like an apartment complex. Maybe it's a down payment, maybe it's buying it all in cash, doesn't really matter here. But now, guess what you get to take advantage of? A little something called depreciation, which I've covered on this channel before. Something I take advantage of with my much smaller portfolio. My rental income was completely offset by depreciation. But depreciation generally refers to the fact that you can write down the value of the property after you buy it, because the property is losing value over time because you have to make repairs and stuff like that. If you weren't making repairs, the IRS says that the property's depreciating in value, so you can actually take that and put it onto your tax bill as a loss. So even though you might be cash flow positive on that piece of real estate, you can often take a net loss on your tax bill because of things like depreciation. And it's just one of many deductions. It just happens to be a very huge one in the real estate world. But there's an extra level to depreciation that people can take advantage of, where you do what's called a cost segregation analysis, where you can accelerate the depreciation on a portion of the property or some part of the property because it is on a different depreciation schedule. So now you can accelerate the depreciation even faster, make the loss even bigger up front, and therefore you have a huge tax write-off in that first year. Or maybe not just the first year, but the second year, third year, fourth year, however long the accelerated portion of that cost segregation is. It can vary a lot, and this is what accountants and tax professionals are really good for. They can help bigger investors in particular take advantage of these massive tax loopholes that are built into the system very intentionally. And let's say with that $20 million investment into an apartment complex, because of a cost segregation analysis to bring you all this depreciation onto that tax year, you get a $10 million write-off in that first year. Now you have a $10 million tax write-off that you can take advantage of by having a very low tax bill that year. I don't know what your income is because you're very, very wealthy, probably have lots of income streams coming in, but you have this huge tax write-off that you got by using margin, taking it out of your stock portfolio, never had to sell any stock, bought this property, got a huge write-off for the first year or two or three or however many, and even beyond that, you're going to have lots of depreciation to take advantage of, and all of a sudden you have a great tax position to where you have a big loss that you can pull onto your normal tax bill, and maybe you're not paying any taxes that year either. The point is, you don't have to actually sell your stocks to move the money into something else. You basically multiply it by using leverage, and that adds risk to the overarching system. When you have more people being encouraged to use things like margin debt to avoid taxes or to do something like the strategy I just outlined, that is adding risk to the system. Any amount of debt is going to make things more risky because in the event of a liquidity crisis or in the event that a market crashes or a stock crashes, all of a sudden that person needs to come up with the money to pay for the debt. I mean, look no further than the Bill Hwang example I went over on this channel a while ago about how he lost $20 billion in net worth in a blink of an eye, and more importantly, arguably, his lenders lost billions of dollars as well, and those lenders now can't lend to other people or institutions, and that is no good. So I would certainly argue that increasing the capital gains tax rate would not really do anything to bring in significant revenue. Instead, it would change investment behavior, and most likely it would encourage the use of more debt and things like that to then take advantage of moving the money into more tax favorable investments like real estate in many cases, where you have huge write-offs to take advantage of. Real estate's just one example. There are many others. That's just one that happens to be very scalable, especially when you get into huge apartment complexes or large commercial buildings. You can have some pretty substantial write-offs just by purchasing a building. So the only people that actually lose in this situation are the people that want to cash out and maybe want to actually spend their money on something besides leaving it in stocks or leaving it in whatever. Instead, you're encouraging the use of more debt to move it into other things to where they are offsetting their taxes. Meanwhile, other people don't necessarily have that amount of liquidity or scale to take advantage of huge tax write-offs like that. You certainly can take advantage of a lot, even at a small scale. So the proposed goal of actually raising revenue isn't really achieved, and guess who has to make up the rest of the bill? So that's pretty much all I wanted to talk about today. Just wanted to point out the fact that even if the capital gains tax rate for top earners goes way up, it doesn't mean that it's actually going to raise revenue. Instead, the money will go where it is treated best. And in this case, the example I used was a piece of real estate. It could be many other types of tax write-off, heavy investments, or not even investments, maybe expenses into other businesses or something like that. There are tons of write-offs in this nauseatingly complex tax code that the US has. And as a politician, it might be a great talking point, but it's not necessarily going to produce those results that the politician might be promising. Anyways, if you like this video, definitely like it since that would help the channel out a lot. And if you like this sort of content about investing and personal finance, then definitely subscribe since I put out new videos every single week and wouldn't want you guys to miss out. And speaking of real estate, definitely check out my book, The One Property Retirement, about a simple strategy for building your retirement nest egg using real estate. It's definitely tailored towards beginners who might be unfamiliar with the real estate buying process, since it takes you from the very beginning of the deal, running the numbers, vetting the deal, all the way through the closing process and beyond with maintaining and renting out the property. So if you guys are interested in that, definitely check that out. And if you end up reading the book, definitely leave a review on Amazon since that would help me out a lot. But until next time, take care.